Have you ever wondered how mutual funds work? They might seem complicated, but when you break them down, they're really quite simple. In essence, a mutual fund is a pool of money from multiple investors that's managed by a professional. This professional, known as the fund manager, uses this pool of money to invest in a variety of financial instruments such as stocks, bonds, or other assets, aiming to generate returns for the investors. Now imagine you're a beginner investor in 2024. There are thousands of mutual funds out there. Which ones should you consider? Well, here are 5 that have shown consistent performance and are well suited for those starting their investment journey: Vanguard 500 Index Fund, T. Rowe Price Equity Income Fund, Fidelity Contra Fund, Schwab Total Stock Market Index Fund, and JP Morgan US Equity Fund. Remember, past performance is not indicative of future results, so always do your research before investing. So, why are mutual funds important? One word: diversification. Diversification is the process of spreading your investments across various assets to reduce risk. Think of it as not putting all your eggs in one basket. By investing in a mutual fund, you automatically diversify your portfolio because each fund invests in a multitude of different assets. This reduces your risk as the impact of any one asset performing poorly is minimized. But it's not just about diversifying your portfolio. It's also about choosing between active and passive mutual funds. Active funds are managed by professionals who make investment decisions in an attempt to outperform the market. On the other hand, passive funds simply track a market index. While active funds have the potential for higher returns, they also come with higher fees and the risk that the fund manager may not make the best decisions. Passive funds, with their lower fees and predictable performance, can be a safer choice, especially for beginners. Now, the crucial question: how to pick the right mutual fund for you? Start by identifying your financial goals. Are you saving for retirement, a down payment on a house, or your child's education? Next, consider your risk tolerance. Can you stomach large swings in the value of your investment, or do you prefer a slow and steady growth? Finally, look at the fees associated with the fund. Lower fees mean more of your money is working for you. To summarize, mutual funds are an excellent way for beginner investors to get started. They offer diversification, a choice between active and passive management, and a range of options to suit different goals and risk appetites. Remember, the key to successful investing is research, understanding your own financial goals and risk tolerance, and keeping a keen eye on fees. So, are you ready to dip your toes into the world of mutual funds?